5 Facts about the definition of recession. A recession is a significant, widespread, and prolonged downturn in economic activity that affects real GDP, employment, income, industrial production, and consumer spending. In the U.S., the National Bureau of Economic Research, or NBER, makes the official call. Recessions can be triggered by a variety of factors, some internal, some external. High inflation, for example, can lead central banks to raise interest rates, which slows down borrowing and investment, a major factor in the early 1980s recession. Trade disruptions, oil price shocks, or geopolitical crises can play a role. When central banks raise rates too aggressively to fight inflation, it can tip the economy into contraction. The Great Depression remains the longest and most severe recession in U.S. history, which began with the stock market crash of October 1929. The true depth of the depression was caused by a combination of bank failures, deflation, collapsing consumer demand, and poor monetary policy. Unemployment reached 25%, and GDP shrank by nearly 30%. It wasn't until the massive government spending of World War II that the U.S. economy fully recovered. The Great Depression changed the way economists, politicians, and the public understood recessions, leading to the development of modern macroeconomic policies. In the 21st century, the U.S. faced another historic downturn, the Great Recession of 2008. Triggered by the bursting of the housing bubble and the collapse of financial institutions that were deeply invested in subprime mortgages. Lehman Brothers' bankruptcy triggered panic in global credit markets, unemployment soared to over 10%, and millions of Americans lost their homes. This recession led to sweeping reforms, including the Dodd-Frank Act, and massive monetary stimulus. The Federal Reserve slashed interest rates and launched quantitative easing, injecting trillions into the economy to stimulate recovery. On the fiscal side, Congress can pass stimulus bills, like tax cuts, infrastructure spending, or direct payments to households. On the monetary side, the Fed can lower interest rates, making borrowing cheaper, or engage in asset purchases to inject liquidity into the financial system. During COVID-19 in 2020, the U.S. entered a brief but sharp recession. In response, the government passed the CARES Act and other relief measures, while the Fed cut rates to zero and provided emergency lending. This unprecedented response shortened the downturn and spurred a rapid, if uneven, recovery. Recessions, though painful, are part of the economic cycle, and their causes and consequences help us build better policy to prepare for the future. If you liked this video, like and subscribe. Thanks for watching.